Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. A massive interview for you tonight. Anthony Power and I are pleased to welcome back Daniel Roberts, the co-CEO of IREN. They just put out their fiscal year 25 and Q4 results last night. We've got him on the podcast to answer your questions today. IREN hit new all-time highs during trading. There's a ton of interest in this name, and we couldn't be more excited to get into today's discussion. Before we do, hit the like button. Feel free to subscribe, and with that being said, let's get into today's interview. All right, you guys, that's right. The main event tonight, Q4 and fiscal year 2025 earnings from IREN. We've got the co-founder, co-CEO, Daniel Roberts, back on the program. We could not be more excited for this discussion. Obviously, a tremendous day of trading for IREN on the backs of last night's earnings call. Daniel, on behalf of myself, Anthony, congratulations on the year, and what an awesome earnings call to attend last night.
Thanks, Bryce. Good to see you guys.
Most definitely. Hey, we've got a good list of questions. We tried to switch it up a little bit based on what was asked last night in our subscriber base. The first one, I'm sorry, will probably be a bit of a repeat for you, but can you talk about some of the key financial highlights? I know you set a number of records on the financial side of things. Operationally, again, just a tremendous amount of work that was completed last year.
Yeah, absolutely. So we're a 30 June year end. So our FY25 revenue hit $501 million, which was up 168% year on year. But what was also exciting was Q4 as a quarter standalone was $187 million, which is indicative, I guess, of the late growth and the achievement of 50 exahash late in FY25. Again, reporting net income, our EBITDA was about 10 times up to $278 million, again showing that profitable growth, which we think is very important. Operationally, as you alluded to, we expanded our contracted grid connected power to almost 3 gigawatts. We've got a multi-gigawatt pipeline behind that. We achieved 50 exahash. But importantly, sitting here today, we're doing run rate revenue of about $1 billion per year on the Bitcoin mining business. And we announced procurement of 10,900 GPU servers from Nvidia, which should take our AI cloud services business up to around 2 to 250 million annualized revenue by December.
That's an awesome summarization of what the results were, and I mean we're still trying to get over the July operational update. Never mind the earnings update. I mean the July update came out, and I think that really just emphasised what the company's all about. I mean, not only have you achieved all your hash rate targets going through 2024, 2025, and believe you me, I remember seeing that update last year when you were at 10 exahash and you change your target to 30 by the end of the year. And I think a lot of people are scratching heads and saying, well, it's took them like 2.5 years to get to 10 and they're going to do double that in the space of 6 months. And you did that, and you did another 20 exahash in 2025. One thing I've been covering you from the start since your IPO, Dan, and one thing that you've always had is consistently good operational results. You've never been outside the top 3 miners in terms of that. And in July, you basically broke all the records, and I think people then really sensed this is something special coming through. You knocked a few of the peer miners off the perch a little bit there, surprisingly, managing to get more Bitcoin out in the sort of like months where maybe more curtailments is used to, and then obviously with the earnings coming out there. And you're quite right. This annualized revenue now, it's significant.
Yeah, I think July, August is always a tougher time of year for traditional Bitcoin miners, because when you're racking these ASICs up in shipping containers and sea cans, the heat gets to them, right? And this has been the whole value proposition of IREN. We've never subscribed to that business model. We've built proper data centers to house these ASICs. So in summer when the temperatures spike, our ventilation, our cooling works fine, and we don't see the drop off that others see. So Yeah, like it goes to plan in July, August, and that's what allows us to operate GPUs for AI in exactly the same data centers.
Hey, now
Yeah,
Dan,
and
one
just
of
a,
the,
a couple of sorry, just a couple of things just to wrap up. Obviously, we saw the successful transition to the GAAP accounting now, obviously, and obviously in the supplementary information there, we noticed obviously the closure now of the issue now with NYDIG that seems to have gone away now, and obviously a note there in the accounts regarding tariffs, but obviously you're operating in Canada as well as the US, so it does give you some sort of like opportunity to lower that risk. Is this something that is a concern with GPUs in the future, or certain chips or certain chips or equipment less of an issue with regards to tariffs going forward?
So Canada, we're obviously outside the US tariff regime, and that's where we're importing the GPUs today. The US, look, it's still a work in process. There's semiconductor exemptions that have been finalised. The bottom line is we've got the capacity, we're seeing the demand, the supply is going to come online. There is going to be a market-based solution for this, and it's clear that the US administration wants to be a leader in AI. So we're not concerned about it. There might be a few bumps in the road around tariffs on, off, but at the end of the day, we've just got to make good commercial decisions and make sure that we're making good economics off the purchases that we make.
Hey, one of the themes that I personally noticed on the call yesterday was this theme of flexibility in your business, and you've been talking about using Bitcoin mining to bootstrap the growth of your data centers for years now, Dan. It appears you guys are really in the driver's seat in terms of co-location deals or AI cloud. You've got the owner-operator experience with the GPUs. Part of the, I guess, upside surprise last night was the announcement of those additional GPUs, bringing you guys up in excess of 10,000 here in Canada. Then you started talking about the roadmap to get to 20,000, modeling out new buildings in Prince George, and then eventually those two other BC sites could get you up to the 60,000 here in Canada. When you start to extrapolate or project out the revenue run rates on those type of numbers of GPUs, it's pretty eye-watering. Can you talk to us about what that really represents in terms of potential for IREN, and how quickly you expect to go from the 10 to 60, whether there's a consistent cadence or that's more so customer demand driven?
Absolutely. So we had a follow-up call with one of our largest institutional shareholders last night, actually. They said, you guys have just established a reputation for creating and curating the most optionality that we've ever seen in listed markets. And I think that's been an underpinning of Will and I's approach to this business when you're dealing with such volatility in terms of the macro and these huge tailwinds in terms of how it might play out. Preserving that optionality is key. So the ability to, I guess, straddle Bitcoin mining, AI co-location, AI cloud services, it gives you enormous optionality and the ability to pursue different markets based on where the return and the risk profiles sit at any point in time. Today, we see the biggest opportunity in AI cloud services when you can buy these chips on a 3-year payback, and that's not just the chip, that's the entire data center. When you compare that to co-location and some of the risks involved there, sitting here right now, AI cloud looks super compelling. And part of the reason why those returns exist is not everyone can do it. There are a lot of technical requirements and expertise that you need to stand up an AI cloud service. And we've been building that capability for the last couple of years. And it probably goes back further in terms of the multi-tenancy nature of our original data center infrastructure. So that just gives us huge optionality to pursue the area of the market where we see the best risk return.
In terms of the service that you're providing in Canada, using this on-demand service, can you tell, like, some of the retail investors that will be tuning into the podcast, the importance of like utilization, and is it as big a factor now as it was at the start with the drive for AI across North America?
Yeah, it's interesting. This popped up a few times yesterday in the analyst follow-ups and this concept of utilization. And I was a bit confused because The concept of owning these GPUs and not having them almost fully utilized is something that hasn't really crossed our minds, but it's becoming apparent that not every cloud business operates this way, and that there is a natural level of underutilization, and it's relatively high. So it hasn't been relevant for us. The vast majority of our current GPU fleet is contracted. In fact, I think the only ones that aren't are some internal nodes that we're using for R&D. We've got access to multi-year agreements. In reality, we stagger maturities, everything from 1 month through to 3 years. And part of that's portfolio diversification for us. Part of it's just meeting customer demands and their needs. And look, while Reserve provides predictable revenue, having access to some of those, or the ability to offer shorter term or even on demand where the economics can be attractive, it is a good way to add to the profile of what we're able to offer the market.
Yeah, just an extension on that one as well, Daniel. Two other concepts that came up in the analyst questions again last night. Rack density. It appears IREN is on the leading edge so much that it may be a bit ahead of where the industry is right now. And then PUE as well, if you can just explain what that is and the importance of that ratio in the data center industry.
Sure. So rack density, for the listeners, refers to a 6-foot cabinet in a data center and how much power goes into that 6-foot high cabinet. So 80% of global data centers have rack density of 5 kilowatts or less. What we're seeing is an increase in density as a result of all these GPU and HPC workloads. So we announced 200 kilowatt liquid cooled rack density for Horizon 1, our 50 megawatt DLC facility in Texas. But as it's playing out, actual rack densities that are able to be delivered today are less than that. So we've incorporated additional flexibility in that data center to accommodate less than 200, whilst also accommodating the ability to house 200 kilowatt rack density in the future as those additional generations are built. Now, PUE, essentially, this is a metric of how much ancillary power you use in a data center that isn't used for the IT load, so independent of the compute. So if you have a PUE of 1.5, then out of every 1.5 units of energy that you consume, 0.5 is for ancillary, such as cooling, IT comms, etc. The 1 is the compute, so the actual usable load. So in British Columbia, we're operating at 1.1 PUE or lower, which is obviously super competitive. And then our Horizon 1 DLC facility is looking like an average of around 1.2. So super competitive, and this allows us to keep costs down for customers and utilize more of, I guess, that precious power from the grid for proper IT compute load rather than ancillary cooling infrastructure.
Now, for me, one of the highlights of yesterday's earnings call was actually the introduction of Anthony to the team. Obviously, we've had the privilege of having Kent on the podcast, and I'm sure in the future we may be able to get an invitation to Anthony to come on and explain his role. How important is it for IREN to get these type of hires in? And can you talk more about the broader team that you've had to bring in over the last 6 months to meet your sort of like strategy going forward in terms of whichever strategy for HPC you're taking on?
Yeah, look, Anthony's a fantastic hire. Most recently, he was group treasurer at one of Australia's largest banks, and in the investment banking side there. So we've known him for a number of years, and we're very pleased to bring him on board. And even though he's only been here what feels like a few weeks, he's already had a very large impact. We've seen with some of those hardware financing deals that he's secured, where he's managed to secure 100% lease financing against batches of GPUs at single-digit interest rates. So they're not deals that we're seeing widely spread in the market, and it's a testament to the value that he's already adding. And I guess when you look at a business like ours that's growing so quickly, value creation for shareholders is about two things. One is the end market and the opportunity to deploy capital to earn the returns that we are in things like AI cloud. But how you fund it and how you finance it is directly related to the value that you could deliver for shareholders. There's no point having all these fantastic investment opportunities if you're not able to finance it on an accretive basis. And with Anthony joining us as Chief Capital Officer, we feel like we're dedicating some really good resources and momentum into that area of the business. And the first two deals over the last week are great, but like everything we've done, we're very much focused on the next ones.
In terms of that, and those two deals are obviously fantastic. They came across really well today. In terms of the scale that you're trying to achieve over this next few years, do you see this just being like the tip of the iceberg and the ability to go and do that on a larger scale going forward?
Absolutely. I mean, you guys have known us for a few years now. We don't tend to
Don't
sit
do small.
and think small. And it's funny, we join these podcasts and we have our earnings calls and we're talking a lot about what we've achieved to date and what we're doing today. But 90% of our headspace, once I jump off this call, I'm not talking or thinking about any of the stuff that we've just discussed. It's all about what's next. How do we grow beyond Horizon 1? How do we fill that up with GPUs, whether it's our own, whether it's a third party through co-location? How do we finance different structures? So we've got a team set up that's very much focused on that. It's great to look in the rearview mirror sometimes and celebrate the quarter and the year that we've had, but it's not our nature to sit still. So onwards and upwards.
Hey, we'll take the forward info if you're able to share it, but I don't know if you are, so we'll have to stick in the rear view. Hey, another thing you brought up on the earnings call that I didn't really think of was this competitive advantage that you guys have. One example is in staffing. So you had said a lot of people, they just don't have the GPU capacity to sell. So their sales teams are sitting there, not a lot to do. Maybe they want to come over to IREN. I'm sure you're getting a lot of the technical experts wanting to come there now that you're owning and operating this size of fleet. Then you talked about some of the advantages with co-location, the fact that you guys are vertically integrated, you don't have those co-location fees. So it appears, again, in the interest of flexibility, you've now created the scene here. You guys have a lot of levers at your advantage or disposal that other companies involved only in part of the value chain maybe don't. Can you talk to us about some of these kind of core competitive advantages, whether it be staffing, the internal knowledge base, some of the opportunities on the finance side that just aren't available to the other maybe miners that are looking to get into this space?
Sure, and this is part of the strategy. We've built out 800 megawatts of high performance compute data centers. We've bootstrapped them with Bitcoin as we said we would, and we're layering in higher and better use cases over time as they emerge in the market. So the playbook from 7 years ago when we launched our seed fundraising round is just being played out. We don't know what the future holds, but we do believe in a digital future. We do believe humanity is going online and it's going to drive insatiable appetite for compute, but we can't prescribe what that's going to look like. We just want to be positioned to monetize it. So having 800 megawatts of data centers operating today, let alone the additional 2.1 gigawatts of powered land we haven't built out into, provides enormous runway for both near-term immediate growth as well as kind of staggered growth over the coming few years. And I think when you look at competitive advantage, vertical integration, super important. I know we've harped on about this for many, many years, and it becomes just a bit of a tagline without much substance. But the issue is you've got full control. When you own the dirt, the transmission line connection, the substations, the data centers, the layers of the compute, particularly in a founder-led business where Will and I, we are super involved, we are thinking long-term, the ability to drive good decisions in the moment, rather than having a misalignment of incentives where we're focused on short-term, whether that's to optimize different objectives rather than, I guess, long-term shareholder value. It does mean that we're able to make good decisions, but importantly, as you alluded to, we don't pay co-location fees. So we've immediately got an advantage over other AI cloud service providers because of that lack of fee. But the vertical integration also goes further. Unlike a neo cloud or an AI cloud, we don't sit in the middle of a customer and a data center. When there's an issue, and issues always pop up, that's life. We are on site, we're immediately able to rectify. And in fact, we're often quite proactive in terms of telling the client there's an issue before they've even spotted it. And you compare that to a traditional neo cloud model where all they can do is be beholden to SLAs with their data center contract because they're just a middleman. And if there's an issue with the GPUs, they just lodge a ticket and it's like, okay, well, we'll come back to you between 9 and 5 on a business day, provide 3 days notice, and then we can get in there. So you can see naturally how the service provision becomes a lot more compelling. And then on a staffing side, I mean, people see this stuff and your sales guys sitting inside some of these other companies, they're getting paid bonuses even though they can't sell GPUs, just as a retention mechanism. But eventually, human nature, people want to do stuff. And then they see us with this really short-term ability to scale and the fact that we are executing on it now and saying, wow, I've got customer demand. I really want to be selling GPUs. I can't where I am now because we don't have access to data center capacity or GPUs. So the ability to, I guess, attract and retain good people is starting to feed on itself because of all those factors.
Just switching down to the Childress site, it was great to see the most up-to-date photographs now of the construction of Horizon 1, how that's progressing. Looks like it's doing really well. Everything looks on track for the end of the year. Now, I remember in our last podcast, which was one of our biggest podcasts of the year, Dan, to be honest with you, you indicated in there that you'd probably have a name by the end of the year of a potential partner. Now, obviously, the conversation that we saw yesterday on earnings and this vertical integration, may change the landscape of that. But obviously, you're in a better position now, probably around the negotiation table. The fact that you can deliver the service yourselves doesn't mean to say that you'd never look at the co-location deal. But with Horizon 1 coming online by the end of the year, do you expect either strategy to be able to be adopted in place at that time then, in terms of getting that facility up and running with GPUs in quick time once it's energized?
Absolutely. We don't intend for the facility to sit there empty, and we could have signed contracts already, just like we could have signed contracts for Sweetwater. And we've been very transparent over the last 12, 15 months around that. And this goes to the optionality we're trying to create, understanding the value, understanding the opportunity cost. And that's not to suggest that we're going to try and over optimize to the nth degree. Like, you do need to get on with it, make decisions, which I think we've also demonstrated an ability to do. So, look, we still have time, and time is our friend. We've got months until that facility is commissioned. As you say, we've now created additional optionality through being able to provide that through a cloud service. So working through conversations with a very large range of prospective partners across both cloud and co-location over the coming month or so is exciting. And I don't know where it's going to land. All I can do is to look at what the options are and then analyze it through a risk return lens to make the right decision.
And one of the key point, which again you sort of like mentioned on the last podcast, and one of your answers to one of the analysts yesterday, which was again intriguing, the fact that you've just built obviously your 50 exahash of mining, and now you're focusing on a second facility, Horizon 2, and people obviously were saying that they were trying to obviously calculate the amount of power in their heads during the earnings call to see how would that work. And you quite clearly said you're prepared to move mining, to another location, maybe to Sweetwater, if the return on investment of the power usage warranted such a thing. And sort of like aside to that, I mean, you're in the sort of like optimum space at the moment from a Bitcoin mining. I don't think any other miner, if we just look at the fact that the mining metrics produced a profit in this recent quarter, so you're at the optimum position there. But I mean, what's your view on the mining, in say 2 to 3 years' time as we approach the next halving, and the fact that you've now no longer got a target to get to an exahash?
I mean, we can ramp back up mining very quickly, but it's all subject to market. Again, we're not going to be dogmatic around what we do in this business. We're here to make money and to make money for our shareholders, and that just involves making good decisions. And when you look at value creation, as I said before, it's about sources and uses of capital. And use of capital for Bitcoin mining, it is high returning on a nominal basis. The absolute returns, cash on cash, they're good. And $1 billion run rate of annualized revenue sitting here today, it's brilliant. Like, we love it. But the reality is that the market isn't valuing Bitcoin mining. And whether that's because we get thrown in the bucket of all Bitcoin miners, most of which, if not all, have struggled to ever make a profit, or whether that's just a general indictment from an investor market on Bitcoin mining full stop, I don't know. And it's really hard to pick that out over time. I think we will learn more. But the opportunity in front of us right now, the value creation wedge, if you like, for AI cloud is clear. When Anthony Lewis, our Chief Capital Officer, can go and finance GPUs 100% on single digit implied lease rates, and we can pay back the price of those GPUs and the data center infrastructure in 3 years, it's a bit of a no-brainer. Now, if Bitcoin goes to $300,000 over the next 18 months and returns on mining really spike and that value creation wedge appears, then we reserve the right to pivot and go and pursue that in parallel or alternatively. But you can only make good decisions. And this is the optionality in the platform, right? Like, just make good decisions in the moment, thinking about the long term to generate that value for shareholders today.
That's great. Hey, just a couple of quick follow-ups from me. In terms of the lease structure you guys have, Anthony just mentioned about scaling that up. It sounds like you'll be able to get similar terms as you continue to progress. You also talked a little bit about the return optionality. You mentioned a 2-year payback on the GPUs, 3 years if you add infrastructure. What would happen if newer models come out? Do you have the optionality to upgrade these GPUs as part of the lease agreement?
Yep, we do. So it gives us even more flexibility in the sense that the lease is for 24, 36 months. At the end of that lease, there is a decision point, and generally they involve optionality around what we want to do with the hardware, whether we buy it. In some cases, you buy it for $1. In some cases, you buy it for the lower of fair market value and a fixed residual percentage. But it does give you flexibility to look at the market at that point in time and work out whether it's worth on balance sheet those units and continuing to sell them, or potentially upgrade to the next generation.
Yeah, and that was a common question the retail audience kept asking about payback periods. So I'm glad you clarified that. The other one we had in the deck, it talks about the eventual growth into the second half of 2027, up into the 2.9 gigawatt realm. Can you talk to us a little bit about substation energization and clarifying what that means in terms of the data center? When the substation is energized, say at Sweetwater 1 or 2, do you expect to have data centers ready to go at that point, or would that essentially be the kickoff to start building those data centers?
We wouldn't wait for the substations to be energized before building the data center, because the data center has a lead time. If you know the power's coming, then it makes sense to build earlier. But to date, we haven't committed to what data center we are going to build at Sweetwater, so we haven't commenced construction. Energization of that site remains on track, as it always has, for April next year. So we are getting closer to that date, and we're thinking actively around how we monetize that site. We continue to be in conversations with different proponents around powered shells and turnkey co-location. But equally, let's see how this AI cloud business goes over the coming months. There's only so many data centers you can build out every 12 months. And like Bitcoin mining, and we saw there, while we ultimately got to a cadence of 50 megawatts per month in data center capacity, like, you don't start there. And for us, one of the big choke points in the industry that we're seeing is not just powered land, but it's the actual capability to execute and build the data center capacity. So it's all hands on deck for us in terms of working out how much liquid cooled capacity we can build across those sites by the end of next year. And then it's saying, well, there is a bucket of energized data center megawatts, not powered land, data center megawatts, and that's what you monetize. What's the highest and best use case for that? And then what does it look like going into 2027 in terms of the cadence of the build out and how quickly we can scale up from there?
in terms of them building data centers, and we've known that over the past 3 years, IREN produces really good data centers for Bitcoin mining. When the discussions first came out about miners moving towards high performance compute and the cost of building, effectively, people using these terminology like a tier 3 data center, and we've seen peer miners now starting to look at some sort of like a hybrid solution. So not a Bitcoin mine data center, not a tier 3, somewhere in a bit that meets the requirements. How are you finding, the data centers for high performance compute in terms of the cost of building them, compared to what people were talking about, this sort of like, millions of dollars per megawatt? So are you sort of finding some sort of hybrid ground as well to deliver a good data center for the requirement?
Absolutely. And it comes back to everything, which is first principles. So don't do things the way that people think they should necessarily be done. Go back to first principles and build it up from scratch, which is what we did for our original air-cooled data centers, building out at $700,000 a megawatt of capacity, operating at 1.1 or less PUE, and operating an Nvidia GPU AI cloud service. Like, as I repeat those numbers, people still don't believe them, but we've been doing it for a year. So you
Yeah.
just extrapolate the same thought process, the same analytics to what you're doing on the liquid cooled stuff. Go back to first principles, work out what you need, the most cost effective, efficient way to build it. So we're super convinced that we'll remain a very competitive build cost, partly simply because we don't have layers of margin. We don't have an overall EPC wrap. We don't go and pay big design fees. We work everything out for ourselves and we then build it ourselves as well. And yes, you subcontract certain specialist components like the package plant, chillers, coolers, etc. But within the overall delivery, we are in full control. And that goes to very competitive costs. But most importantly, it's risk. Like, why put your destiny in the hands of a third party? Control it yourself, because people let you down. And if you want something done, you're better off doing it yourself.
Speaking of growth, you talk about some of these other facilities in BC. When we hear about HPC AI, a lot of people think close to big urban centers, latency, fiber optics, redundancy. For anyone who's been to Prince George or some of these other sites, Mackenzie, these are not super urbanized areas. These are fairly remote. However, IREN's been able to make that work. You guys obviously have strong utilization rates. So kind of a two-parter. The two other sites in BC, are they similar in terms of these requirements like latency and fiber? And how has IREN been able to take these data centers and get such a high utilization rate despite maybe not that proximity to a large urban site?
Yeah, it's funny you say that, Bryce. It's like the world and people are really good at just presenting a viewpoint that they feel is right. And there's just a way of things, and there's a way of things that you should think about things. And you've got to strip it back and look at first principles and say, right, what drives a requirement for a data center? What's important? And for years, we've been harping on around the fact that latency at these sites is small. Like, even our worst latency of 20 milliseconds, there's 1,000 milliseconds in a second. Like, is 20 milliseconds really going to be a big deal? And everyone's like, oh, no, latency is important. I mean, we were on a call with someone at a hyperscale that's responsible for their cloud a couple of months ago. And they said, oh, just one concern we've got around how remote these facilities are. I said, but this is what we've got to get our heads around. It's the real world versus the digital world. The digital world, it is not remote. 6 millisecond round trip latency to Dallas from Horizon. Like, that is effectively adjacent for all intents and purposes. The fact that it's physically located, that doesn't matter. We live in the digital world now. Let us take care of the real world. So everyone's on this journey in terms of working out what makes sense, what they need. And the reality today is, out of Prince George, we are operating both training and inference. And I think as we extrapolate this out over the coming years, my prediction is you're going to see general data center workloads just move to these areas. They're going to become general availability zones. Now, whether the hyperscalers realize it today or they're on the journey or acknowledge it, I think it's going to be the reality. Just like we were told 7 years ago by these same people that they would never build a data center outside a metropolitan area, The reality is the demands change, the circumstances change, and what you think today is not relevant when you get to that future point in time and the constraints you're dealing with.
Yeah. In terms of your size of power that you have at your availability, nearly 3 gigawatts of power now over the next few years. We've been seeing for the last 12 to 18 months a number of peer miners talk about pipeline, and you guys have actually got sites. You're putting power onto those sites as we speak now. Are you seeing? I mean, 3 gigawatts is a lot to fill, and obviously that's going to create a lot of a big business moving forward. Do you still have time to look at what happens after that, or are you just focused on let's get the three gigawatts finished first before we start looking at the next phase? Or are you constantly thinking, actually, there's an opportunity here for the future?
Yeah, look, that word pipeline, I've spent almost 2 decades now developing infrastructure assets across various asset class, wind farms, solar farms, regional livestock exchanges, waste treatment facilities. Like, we've done a lot of this before. And the word pipeline, it just implies a made-up spreadsheet in my mind. Like, pipelines never come off, and you have to apply a massive discount to any of it. Like, I live in the world of realities and ones and zeros. You either have something or you don't. If you have something, then sure, educate people on what it's got. If you don't, then sure, tell people that you intend to try and create something, but let's not shy away from the risks. And it is really hard to get grid connected power. All those pipelines that people have been talking about for 12 to 15 months, they're still pipelines. But you've got to get that signed contract. And I could sit here for 2 hours and talk you through a ginormous spreadsheet with a pipeline of all our projects, but it's made up. Like, it actually means nothing until we get that signature on a connection agreement and bring it all together.
Hey, last one for me, and then I'll let Anthony finish up. Our good friend Franz Baker, I think, posted this. Some of those guys' research on IREN is just incredible. He went over to the Nvidia site and was highlighting the fact that you're now that preferred partner status. So again, for the general audience here, what does that mean? In terms of procurement, availability of GPUs, and then it looks, based on what was posted there, that Nvidia is now essentially positioning you guys as their preferred provider in Canada. Can you talk to us a little bit about this preferred status and what it means?
It's been a testament to the work internally that the guys have been doing, working with Nvidia, particularly over the last few months. We've obviously scaled up our AI cloud 5 times since the start of this financial year, which is started last month, July. So we've had a lot of conversations with Nvidia. We're working with them around integration into Lepton and their cloud. We've had the opportunity to show them our capabilities and show them where we're going, both in terms of the technical capability today, but the roadmap as to where we want to go. So to receive that validation, and the timing of that so close to the earnings call was fortuitous, and we're very thankful for it. In terms of what it means, yes, they've validated us as a partner. Great. We've got access to supply of GPUs. As I mentioned, we've 5 times our capacity in the last 2 months alone. And also the ability to diversify and attract an entirely new customer cohort as a result is super exciting, as the only constraint to growing this AI cloud is really receiving the units that we've ordered that haven't been plugged in, plug them in, sell them, and then order more. And it's just a bit of a flywheel that we've got in front of us. And if the market's there, the financing's certainly there, and it could be a really exciting 12 months ahead.
Bryce just mentioned there about some of the retail investors, obviously providing a lot of input towards the story of IREN. I mean, I've been in the space for like 6 years now, and I remember when you IPO during that sort of probably towards the height of the bear cycle, which a lot of people in the space sort of left the space then that were doing things that I was doing. I felt that was just me and a couple of others on our own. This last sort of 18 months, we've seen an influx of people that have been supporting and I mean, it's amazing sometimes the information that they manage to get hold of through satellites but IREN, I feel they sort of embrace the fact that the social media from the retail investors really helps to tell that story, and do it more so than maybe some of the peer miners.
Oh, look, I massive credit to all those individuals that you've mentioned by name and not on X, as it's now called. The amount of work they do, the research, their understanding of the business is just sensational, and we're extremely thankful for their support and the work that they've done to educate the market generally on what we're trying to achieve. And look, we will always try to explain it our own way, but having different voices, different perspectives, different ways of explaining things. These guys have done a terrific job. So hats off to them and many thanks.
Just one final thing for me before we allow you to wrap up the conversation. Obviously, yesterday, I posted effectively we saw a changing of the guard. Now it's very early days, but it was nice to see a miner actually take on the sort of market capitalization of Mara, which has probably been the biggest miner since I've been in the space. But you sort of took it on and sort of went past it with a breeze yesterday, having that wonderful earnings results coming out. This will obviously give IREN more availability with the levers for funding your growth going forward from now. I mean, remember the last conversation we had on the last podcast where you'd had to use, the ATM, when the price wasn't as high as it is today, but the price it is today now, it must give you plenty of optionality.
Yeah, look, it does, and numbers go up, numbers go down. It's obviously pleasing to see it up, and we've got some good momentum. In terms of ATM usage, I'm not really sure what we'd use it for at the moment. Obviously, it's good to have a strong share price and the ability to use it, and maybe that changes tomorrow, but we're generating strong free cash flow from our existing operations. We're securing good financing structures to buy new GPUs. Again, it's not something we focus on really that much day to day. Like, it's great and it's good that it fills our investors with confidence and they feel happy, but equally it's important not to get complacent and just think, right, well, the share market's gone one way lately. Don't take that as just absolute validation that every decision you make is right. In fact, let's challenge ourselves and say, what are we doing wrong? Like, where do we need to get to in 12 to 18 months? What are our blind spots? Never just accept that things are good. Obviously, celebrate it. And I mentioned that before. As a team, we went axe throwing yesterday afternoon, something a bit different. Why not? I've never done axe throwing. But this is the thing, like, go and celebrate in the moment, but don't get complacent. Don't just assume that because you've had a good 12 months, the next 12 months is necessarily going to be as good, and just keep working hard.
Still got all the fingers there after that axe throwing event, Dan?
Yeah, we
Excellent.
do.
That's a success. Hey, I just, as I'm listening to this, what would you say, if any, are the bottlenecks on IREN right now? You guys seem to have a pretty clear runway ahead of you. You mentioned just receiving the GPUs is maybe potentially a bottleneck, but with that preferred Nvidia status, what would you say is the choke point right now?
Hours in a day is always a choke point. Be nice to have a few more, but I don't think we can do that. Look, it's going to naturally take a little bit of time to install 10,000 computers. So we've got that opportunity over the next couple of months. So in terms of the demand signals that we're seeing in the market, they absolutely could have warranted procuring more GPUs, but there was no upside. Why buy them now when we're not going to be able to install them because of the labour constraint over the next couple of months? So we've almost got a free hit over the next 4 to 5 weeks where we can look at market demand, see how it's tracking. We can order more GPUs, and we haven't really lost time to compute, if that's even a term, because of that constraint and actually installing them in the data center. So again, we celebrate the 10,900 that we've got operating or we've got on order. We celebrate the 50 exahash, but I'm not thinking about that day to day. It's thinking about when's the next 10,000 coming? When's the right time to order it? What's the market demand look like? How are we going to finance it? How do we manage risk?
Yeah, just incredible seeing it all come together. I wanted to give you the opportunity to close out, but listening to you talk here about the first principles, bringing it back to basics, you think about HPC and AI, how complicated and technical, and innovative this space is. So many companies in the world just can't figure it out. And to your point, Dan, you say, hey, at this point, we just got to plug the GPUs in. I remember last year when you were going towards the 50 exahash, you said, Bryce, we just need to plug the ASICs in. And it was so refreshing to see how calm, cool, collected your team is. So I really want to give you credit for that. You guys have delivered on every single thing you've promised. The transparency to the retail audience is phenomenal, as Anthony pointed out. And again, congratulations on just a phenomenal year.
Thanks, guys. Appreciate all the support and look forward to the next opportunity to chat.
Hey, so do we. You're welcome back at any point. Keep up the great work. You guys, if there's any comments, thoughts we didn't get to in today's discussion, leave them in the comment section below. Hit the like button. Feel free to subscribe. We'll see you back here on Monday.